All right, boys, we're just moving on to cash budgets for consecutive periods. Um, so, look, I mean, it's pretty safe to say that obviously the more uh, frequent a budget is made, the more accurate it's going to be, and the earlier detection of problems is going to occur. So, what we can do is we can set up a budget to run over multiple periods. And that way, basically, what we can do is we can see what's going to be occurring. So, for example, over 3 months, um, in this example here. Now, basically, how this works is you've essentially got three separate statement of receipts and payments on the one report. Now, the advantage of this is that there's numerous advantages to this, but the biggest one is that you can actually see the differences from month to month in terms of um, whether your revenue or your fees are seasonal or change from month to month, and B, where there is any out of the ordinary items. So, for example, here we can see that in October, the business is planning to have a capital contribution. In December, they're planning on having a loan drawdown. So they're two cash inflows that are, I suppose, out of the ordinary, apart from having the cash fees come through. Now, if we go through here, it looks like in November they're going to have to settle their GST account, and they're expecting to be about $2,700. And here in December, they're actually predicting that they will have the purchase of a company car for $35,000. Now, if we have a look at what these do to the figures, um, as we can see here, $10,000, a $10,000 capital contribution. Um, Although if we didn't have it, we would still have a positive figure in the bank balance. It is quite a substantial amount of that transaction of that month. So you know the fact that $10,000 needed to be contributed by the owner may give you an indication of something that could potentially be going wrong with the business. Um, if we move through to November, we can see that that capital contribution is no longer there, and it has actually meant that we have turned up a surplus, a deficit here, which is obviously not an ideal situation. Then, if we move through to December here, we do have the loan drawing down, which is going to give us a little bit more extra cash, but this $35,000 paid out for a company car is going to leave us with quite a substantial overdraft on the back of a very substantial deficit for December. Now, a couple of things to note here. The first thing we need to note is that notice the bank balance at the end of one period ends up becoming the bank balance at the start of the next. Now, that's obviously that's a reasonably obvious thing to say, because what we do with, remember when we're working out our statement of receipts and payments, we have the bank balance at the start plus or minus the surplus or deficit gives us the bank balance at the end. Well, the bank balance at the end of uh, one period is going to end up being the bank balance at the start of the next period. So that's quite straightforward. So that's how that sort of works through there. So that's the first bit. The second bit is more around decision making, and it's actually articulated quite well here. I mean, the budget obviously allows the owner to assess when to undertake particular cash activities. So, for example, when they're going to pay back a loan or when they're going to purchase a non-current asset. So, for example, here in December of 2016, the company might decide that buying a car in this month is not a good idea. Obviously, it's going to leave the bank balance in a bit of a wreck. So they may decide to defer the purchase of the car, or they might even consider contributing additional funds, or perhaps fund the purchase with a loan or other finance instead of putting the bank into overdraft. So on the back of that, if we can just knock over the review questions 9.4, and then there will be another video which we'll need to watch on budgeted income statements.